On the show today, we have Trellance's very own John Wagner. He's talking about, or actually he's asking, should credit unions be prepared to conduct a climate risk analysis? And based on a lot of the climate events we've been having this past year, I think it's a yes. But he fills us in this interview, so check it out. Hey everybody, Mike Lawson here with CU Broadcast. Welcome back to our program. And in our virtual studios, we have Mr. John Wagner from the fine organization called Trellance. John, how are you today, sir?
I am doing very well. How about you, Mike?
I'm doing great. Better now that you are here because we get to talk about a super cool topic about should credit unions be prepared to conduct a climate risk analysis. This is something we don't talk about every day, but it's super important, obviously. So the first question I pose to you, Mr. Wagner, what can a credit union learn from a climate risk analysis? I find this super fascinating.
Yeah, climate risk analysis. So NCUA has done some work on this. They've done some studies, and NCUA says that about 25% of credit unions are at a relatively high risk of climate impacting their credit union. Climate can impact the credit union in a lot of ways.
Yeah.
It can impact the credit union members. Most recently, we had a couple of hurricanes here in the Tampa area.
That's
a lot
right.
of members of local credit unions were impacted.
Yeah.
It can impact your loan portfolio. Think about the loan portfolio real quick. There's a lot of different types of climate risk. There's coastal flooding, there's tornadoes, wildfires, volcanoes, avalanches.
Volcanoes, all right.
There might only be one place where there's volcanoes that are meaningful. But NCUA did this study. They used data that was provided from FEMA. FEMA did a national risk index and said X% of credit union portfolios are at risk for these different climate risks. We can take that data because all you need is address level data, and you can apply that to your portfolio, and you can say, hey, I have this car loan that's way upside down, and it doesn't have a gap policy, and if we have coastal flooding, there's going to be a loss taken by the credit union. So the credit union has to think about that when they're thinking about how climate risk could impact them.
So is it necessary for a credit union? Because based on what you just said, it sure sounds like it's necessary. A climate risk that is. Is this kind of a climate risk analysis necessary?
So NCUA, when they start thinking about things, they'll put a paper out and they'll say, hey, here's some interesting information regarding climate risk and how this might impact credit unions.
Right.
Typically, when they do that, they're eventually going to start looking at what type of risk does this pose to individual credit unions. The short answer is no, it is not required. The longer answer is it would be good practice for credit unions, especially in high-risk areas, California, Texas, Florida, to consider what impact this could have to their credit union. I've mentioned loan portfolios, but there's deposit impacts and member impacts and location impacts. Your branches could be closed. After the hurricanes we had here in September and October, there were credit unions that had branches that were flooded and were closed and are still closed. Mm-hmm. So there are a lot of different impacts that credit unions should consider. They don't have to consider them.
Yeah, it's funny that I don't know, maybe this is an assumption on my part, but it's funny that we don't talk about this stuff until something like those two hurricanes happen, or just last week or so, when the Northwest had that huge snowstorm, mm-hmm. and even the Northeast a couple of weeks ago. So it's something that needs to be proactively, maybe the better question here is how can credit unions prepare for this type of stuff to be proactive in this area instead of reactive, possibly?
So, I've seen reactive, and I live in the Tampa area. My mortgage loan is with a credit union in the Chicago area. When those hurricanes came, they reached out to me immediately after the first hurricane.
Wow.
So they were reactive after the first one. They knew the second one was coming, and they were proactive. They knew where I lived. They knew that I was potentially at risk.
Yeah.
Credit unions can foresee some natural disasters, not everything, but they can foresee some, and they can reach out to their members and offer help in various ways. My credit union offered generic help, but you could offer help in, many other ways.
Mm-hmm. Yeah. Based on based on how you bank with that credit union, what's your accounts, all that type of stuff. They can help you out with that for sure. Yeah, that was the answer I was looking for. I was just trying to be, how can credit unions be more proactive in this area is kind of what I was looking at. So,
I mean, you can't anticipate a tornado, but you can anticipate a hurricane. You can anticipate that the Mississippi River is going to flood. There's things you can pay attention to.
Mm-hmm. Well, which leads me to my next question here. So how can credit unions conduct their own climate risk analysis? Talk about being proactive.
Yeah, being very proactive. So climate risk analysis, the National Risk Index prepared by FEMA, actually breaks the data down by county level or census tract level. Mm-hmm. So credit unions can take and apply those numbers in the National Risk Index to each individual loan in their portfolio. We've done this for a credit union that was interested, and they had about a $4.5 billion real estate portfolio. And when we took and applied FEMA's data against their portfolio, mm-hmm. they had about $3.5 million in loans at risk in that large real estate portfolio.
So, what do you guys at Trellance do in this area? I'm very curious about that. How do you guys come in and help out and help credit unions be proactive in that area?
Yeah, so that's certainly interesting. We have the ability for credit unions to approach us and ask us to do a climate risk analysis. This is brand new for us. We've applied it to one client. We have another one that's interested. So we're waiting for feedback from those clients. So this is a brand new thing for us. But we have proven that we can apply this at least against your loan portfolio. We haven't attempted to take it, and apply it to other areas of the credit union as yet.
Yeah, I think it's like you pointed out, those some of those states that are more susceptible to climate events, such as Florida, Texas, California, and many other states who are affected by this type of stuff would be the ones that would be very, very interested, very curious about something like this. So I think you guys are doing the right thing to offer this to credit unions out there.
Well, thank you.
You're welcome. So, anything else here to add, John? I mean, did we cover everything here? Because I know this is probably a topic that's I think is going to grow in importance, especially as these major climate events keep occurring year after year.
Yeah, anything else to add? I think that it's important for credit unions to consider all the risks, whether it be their loan portfolio or other portfolios. And, if they take the time to do an analysis like this, they can set money aside. They could put it in their CECL reserve, for example, if we're talking about a loan portfolio, and say, hey, we feel like we have, an undue climate risk. So, credit unions have a tendency not to adopt things early. Everybody knows credit unions took a long time to adopt CECL. But early adoption, being prepared, if anybody does say you need to consider this, being prepared is always a positive in the eyes of your examiners.
For sure, and your members as well. Think about how that looks for your members. I mean, you just gave a great example of how you appreciate your credit union, even though they're in Chicago, and how they reached out to you. So, talk about enhancing the loyalty and trust of your financial institution, a credit union in this case. That's pretty awesome.
Yes, it is. And I very much appreciated that they reached out.
Indeed. Well, great message indeed. All right, John, thank you so much for this very important message. And I think it's going to grow in importance in the next, as time goes on. And really good stuff. So appreciate your time.
Thank you for having me. I appreciate it, Mike.
A quick word from our sponsor, Community Financial's present CEO, Tansley Stearns' new podcast, Despite Impossible.